So today's video is sponsored by absolutely nobody because no one cares about this channel, hopefully yet. But while it's sponsored by nobody, this information is meant for everyone because this is something that I think about all the time and I have to remind myself of all the time, even though I've been trading for almost a decade now. And that is how to respond to red days, how to respond strategically, how to respond emotionally to days when your portfolio is sinking in the red. And this is really important because a lot of people, they fall into certain types of traps, and hopefully this video is going to help you by me giving my personal take on what to not do and how to react favorably to red days in your portfolio. So the first is, and it's so important, you have to do your due diligence. Why? It comes back to the old adage. If you don't stand for something, you'll fall for anything. So if you're not sure why you're holding a certain asset, if you just bought a stock because you saw an alert on it in a trading group, or you watched a YouTube video, or your friend told you about it, or your family told you about it, and you went and invested 10 grand, and then all of a sudden it's down 5% in a day, you're going to be freaking out and you're going to want to sell it. And that is not the healthy response. It's not healthy emotionally. It's not healthy for your portfolio. And it's not healthy for you as a long-term investor. The second pitfall that a lot of people fall into that you shouldn't do is chase. And when I say chase, I mean it in two ways. So the first is people chase by wanting to buy the dip. So for instance, you spent $10,000 on a stock that cost $300. Today, it costs $275. A day later, you lost $25 off of each share, and you tell yourself, you know what? I need to average down. I need to put another 5 grand, another 10 grand. I need to buy the dip so that it doesn't look like I'm down a certain amount of percent. I want to be more up. This is not the way to trade. Why? Because you don't know how many dips are coming. You have to have it as an advanced plan. When are you going to sell? You have to have a target price. You also have to have a target price if it slips, not because of something drastically happening with the underlying asset, but just the way that the market moves. Now, the market, there's always price fluctuations. People try to manipulate the news. There's always rollovers in certain indexes, and that affects certain underlying assets. There's also rotations in investments. So you have to keep all of these things in mind, and you have to realize that you're not always going to win. It's okay. It doesn't mean that you're a loser if there is one red day. It doesn't mean that you have to go and do very risky stuff. So one way of chasing is people go and they dump all their money into a stock that's now down so that their percentage doesn't look as big in the red and they feel like they've bought the dip. The thing is that you don't truly know if you've bought the dip unless you're a specialist with technical analysis. Unless you've been following the stock for a really long time, it's hard to really catch those true dips at the very bottom. And so you have to be okay if tomorrow you're going to lose another 10%. Personally, when I take a position, and I'm not a day trader, when I take a position, I ask myself all the time, are you going to be okay if this dips 15% tomorrow? And if my answer is no, then I think harder and I do more research on whether I want to really invest in it and if I truly believe in its potential and if I'm truly bullish on the stock. And so you have to put in the effort, but you also have to realize that it's just one day. It's just one red day. It's just one red week. If nothing drastic happened, the best thing you could do is nothing. Sometimes when you're going through these types of moments and these types of portfolio days, when in doubt, do nothing. And then the other way of chasing is people say, my portfolio is down $2,000 today. So you know what? I watched a video on candlestick charts. I know a little bit of technical analysis. So I'm going to go day trade and I'm going to make up that $2,000. And that sounds like an episode of 24. Like your child has not been kidnapped and you need $2,000 in order to get them back, okay? Or like $10,000 or whatever it is. Like a lot of people, they go on these red days because they feel bad. Something else is going on in their life, and this is also bogging them down. So they say, you know what? I'm going to win the day. I'm going to win today. I'm going to get back after these hedge funds. I'm going to get back after what's going on in my life, and I'm going to crush it. I'm going to make back what I lost today, and I'm going to do it by day trading. And they do super risky stuff, and a lot of the time, more often than not, they lose rather than win money, and now they're down even more, and now they're more depressed, and then they make really bad emotional decisions. They say, oh, I'm down. This isn't for me. I can't handle it. They go and they clean out their portfolio, or they double up and they make even riskier your riskier investments, and or they go on margin. They start trading on margin, even day trading on margin. So you have to keep in mind, you have to keep your feelings in check. You have to keep your emotions in check. This is a game of discipline, and discipline, it doesn't just entail one day. If you slip up and you mess up and you turn this into a casino and you start gambling on your portfolio, it's very hard to reel that back. And you have to realize your portfolio should be solely for investing. And if you want to gamble or you want to do stuff like that, if you want to mess around with day trading, make a different account somewhere. Now, by the way, all of this is not financial advice. This is for entertainment purposes only. And it's my journey. It's the journey of one person. It's one person's opinion. If it helps you, if it hurts you, let me know in the comment section. But do not treat your portfolio like a casino, like a roulette wheel. If you want to do that, go to Vegas, go to Atlantic City, take some money, put it into a different account. So if you have an E-Trade account, open up a Webull account, open up a TD Ameritrade account, put $1,000 in there, and then you can gamble some money in there and see if you're actually good at it. Most of the time, people lose. I don't day trade. It has to be really, really rare, like a short squeeze happening or something crazy where I really have conviction and I've seen it all play out before and I want to go in, and I always have stop losses and stuff. But still, day trading, it's not easy. And the thing is that if you day trade and you win a lot of money, you want to day trade the next day. It's almost like a gambling addiction. Like if you win it, it's a lose-lose, because if you win a lot of money, you want to do it the next day and the next day after, and then usually you go back down to zero or you even lose money. And if you lose money, then you're depressed and then you're not sure and then you feel stupid and you're beating yourself up and you want to just exit all positions and forget about investing altogether. So you have to be careful about chasing. Just one day, just 1 week, it's nothing too crazy. Because having a red day, having a red week, even having a red month, it's not the end of the world. And the other thing to keep in mind, and this is probably the most important thing, is you have to pay attention to how you're feeling on red days. If you're having a red day and it's completely causing you to be depressed, to be super anxious, you're having obsessive compulsive thoughts about trading all day, you are super, super despondent, you're not taking care of your obligations because you lost 3,000, 4,000, you can't stop thinking about it. All this means is that you put way too much out there. You risked too much of your float, or you're trading on margin, or you way overinvested. And what you should do is, hopefully when you make that money back, you should just take out a certain percent off of each position and make sure that a smaller portion of your overall wealth is in your portfolio that you're trading with that's bringing you down. Because at the end of the day, remember, trading, investing, it should be adding value to your life. It shouldn't be stressing you out and shortening your lifespan and affecting your health, affecting your relationships. That is not the healthy thing to do. One of the things I worry about when I make these videos and on other stocks, or I teach people how to buy a certain thing, or I make crypto videos and stuff, the thing is that at some point I'll always be right, and then during some times I'll be wrong as well. And one thing I always think about is on down days, people that have watched my videos, people that might have, made certain decisions or it impacted their due diligence and now they're down, how's it affecting their mental health? How's it affecting their happiness? And this is something that's important to me, because money, making some money off the stock market, is not worth you sullying your happiness. And so you really have to keep that in check and realize, is trading, is investing making me happier? And if it's not, if it's only adding stress to your life, it doesn't mean that you can never trade again, close out all your accounts, and just take your ball and go home. All it means is that you're probably playing with too much and you probably risk too much. And that's why your subconscious, your unconscious, it's kind of telling you, hey man, if you lose even more, this is not good. You're not going to be able to pay your bills, or you've been saving up for this, you're not going to be able to have it. So you have to realize, what type of investor are you? What is your gambling threshold? What is how risk averse are you? Are you okay with things being on the line? And the healthy way to do it that I found in speaking to my friends that are investors is you go in slowly and you build your wealth up slowly and you build your risk tolerance up slowly, and you don't just go all in. You definitely don't chase. You don't risk too much. You never invest more than you can afford to lose, because no one knows what's coming, and absolutely you can get wiped out. People jack up their accounts all the time and it's crazy. I mean, I know stories of friends that have family members that have screwed up the family's, all their savings and really put a lot of things in jeopardy for the family just because they went off the rails trading. And it's important to talk about this stuff because all these stock trading channels, it's all like, hoorah, and this stock's going up and that stock's going up. And oh, we have a day in the red. Put your pinky up and go ahead and buy the dip. But the reality is sometimes you have months, you have years that things are just going red, that you're going to be down certain positions for years. You're going to be down thousands of dollars. You might be down tens of thousands of dollars. And you have to know, what type of investor are you? Are you okay with these risks? If not, just have a small sliver that you throw into stocks, portfolios, set it and forget it. If you're someone that could deal with the stress of it, then you're ahead of the game, because most of us, we don't like the stress of it. This is why people emotionally buy or sell. Aside from the fact that they don't do their research and they don't do their due diligence, most of the time people panic buy or panic sell. Not because they're really afraid of the stock going down forever. They're afraid of the fact that they won't be able to deal with the stock going down, that it's going to affect their sleep, that they're going to get depressed, that they're not going to get enough work done, that they're going to take it out on their family and friends, and they're just worried about their emotional response to it versus actually being worried about what's going on with the underlying asset. And the best thing for that is due diligence. You have to do your research. You have to learn more about your investments, how to invest, and all that good stuff. And the most important thing that you have to do on red days like today, the most important thing that will help you out is you have to subscribe to this channel. That is the number. Warren Buffett has talked about it. The greats. Graham has talked about it. All of the greatest investors of my generation, of their generation before me, ever since the stock market started really, some of their success was due to them subscribing to this channel and following my videos. So do what the greats did. Subscribe, comment, like, and I'll see you guys in the next video.